Hello, and welcome to Strategic Alternatives, the RBC Capital Markets podcast. Please listen to the end of this podcast for important disclaimers. I'm Walter Spracklin, Director of Canadian Research and co-head of Global Industrials Research. Today, we're going to take stock of the Canadian industrials market. RBC has just hosted companies from across the sector at its Canadian Industrials Conference here in Toronto. We heard from 38 participating companies, and we met with a host of investors in this space. Joining me are three of my colleagues who are going to share some of the key themes that emerged from the conference. Sabahat Khan is our North American Industrials Analyst, James McGarragle, Canadian Industrials Analyst, and Matt McKellar, Global Paper and Forest Products Analyst. Let's start with one of the issues that dominated last year's conference, and that's the ongoing freight recession. It's good to report that we've seen signs of progress on that front, which were reflected by the presenters at our conference. There's two real aspects to this story, and that's on the demand side and on the capacity side. From a demand perspective, we have seen a pickup in industrial activity and strength in the US economy, where Canada has lagged a little bit. The real story was on the freight pricing environment, where tighter supply driven by regulatory changes has really stripped out most of the delinquent and let's call it misbehaved of the carriers. And that's resulting in a significant lift in truck pricing. That lift in truck pricing has also had a positive impact on rail rates as well, since the two are competitive on many of the truck lanes. Finally, the war in Iran has also created some opportunities in air cargo capacity as well. So overall, tighter capacity is definitely leading to a nice uptick in freight rates. Also macro related was the US tariff and trade policy. If we were to see any resolution there, that would certainly be a positive catalyst for the Canadian freight transportation companies. So overall, definitely an improved setting compared to where we were in the last couple of years. And when you combine that with some of the company-specific opportunities in rail, truck, and air cargo, the tone of the conference was quite upbeat. Keeping on the topic of U.S. tariffs and trade policy, Sabahat, how has that been affecting your company?
So, tariffs were one of the broader topics that we've been hearing about both at the conference and in a lot of investor conversations leading up to the event. Broadly speaking, you got first derivative impacts that are directly hitting a lot of the companies in our coverage. And then you got second derivative impacts related to some of the uncertainty that tariffs are causing, especially when it relates to large capital projects. So if we look primarily at the direct impacts of some of these tariff announcements and the uncertainty, the big one there is steel. That makes its way through the industrial space through the construction of heavy equipment, HVAC, broader heavy industrials. The punchline here being that tariffs are affecting Canadian firms' profitability broadly, and with prices expected to remain at current levels throughout the year. And that's leading to some uncertainty here. So companies are really looking out to the CUSMA or NAFTA negotiations here and the broader tariff framework to provide some relief. Obviously, varying degrees of impact through our coverage. We've got some heavy machinery names that probably saw some impact at the periphery. And then, as you think about the engineering and construction names, there you're looking at more second derivative impacts. That relates to large projects likely not taking off on time, asset owners maybe pushing off the decision making on when to launch projects, or if you think about industrial manufacturing, companies taking their time to figure out what the final tariff policy looks like before committing to a specific jurisdiction. So in early 25, when the tariffs or the threat of tariffs became a reality, there was a lot of conversations in the industrial space around what this means for large projects. We did see commentary across the space around the push out or a little bit pushing to the right of large opportunities. Likely a little bit of that in the immediate backdrop, but as we look ahead through the summer months, as these negotiations make their way through the system, we do have the expectation that some level of reversal and or clarity on these final tariffs should lead to more broadly improved backdrop as we head into H2 here. But at the conference and in a lot of investor conversations, like I noted, the tariffs have been a bit of a wet blanket on the sentiment across our coverage.
And moving on to Canada's infrastructure plans, the nation building projects and sovereign wealth funds have attracted a lot of attention these days. These are long term plans, but how excited would you say investors are about this across the Canadian industrial scene?
I'm glad you brought that up. This was probably the most topical issue for our companies at the conference. There was a lot of excitement around the headlines that are building with the Build Canada initiatives, a lot of optimism in the broader industrials complex that we cover. This all started with the establishment of major projects office, a lot of federal government announcements around major offices being set up, funding commitments. And as these announcements have made their way into the press, the companies are getting a lot of questions around what exactly does this mean for them. So if we think across our coverage, we'll start with the ENC complex. You have the engineering companies that are at the forefront of the work. They help a lot of these major private and public entities with project design, consulting, advisory work. And then they pass on the plans to the construction firms. And for the construction firms to deliver on some of these major infrastructure initiatives, they then go out, they buy supplies, they buy commodities, they go buy machinery, which then helps our Caterpillar dealers. So, broadly speaking, there is a number one, just improved sentiment across the industrials complex that the government is committed to economic development. Second, you are going to see tangible dollars that are going to flow into the economy. And then just taking it a step further, thinking about the multiplier effect, you'll have job creation across the construction industry, across suppliers, across vendors. So, at a very high level, these major projects or the broader infrastructure initiatives by the government are providing confidence to the market. That in turn is leading to even private enterprises to sort of put their money on the line and start to commit to projects, initiatives that they may have been a bit hesitant to do so in the future. And I think we'll start to see the effects of this through late this year and more pronounced into 27 and 28.
A few of those nation building projects have a bit of a defense twist to them as well, don't they? And James, perhaps touch on how the aerospace industry is impacted by that.
Defense is emerging as a common and potentially durable tailwind across the aerospace names we cover. There's been a lot of noise in the market about whether policy commitments like these actually stick. Our view is that this one has real legs. Canada hit its NATO target of 2% of GDP in defense spending this fiscal year after years of being on the wrong side of that conversation with allies. That's roughly $63 billion in spending. And then at the NATO summit in The Hague last year, alliance members agreed to push that even further to 5% of GDP by 2035. Canada has committed to that path with approximately $82 billion already earmarked over the next 5 years, and the longer term trajectory pointing to over $1 trillion in cumulative spend over the decade. Now, those are big numbers, but what makes it real for the companies we cover is that the policy architecture around that spending is starting to take shape in a very meaningful way. One of the things we highlighted is the launch of the Defense Investment Agency, which is specifically designed to speed up procurement. If you've spent any time around Canadian defense contracting, you know that the traditional procurement process has been painfully slow. Programs drag on for years, sometimes decades. The creation of a dedicated agency to accelerate that pipeline is genuinely significant. It tells you this isn't just a budget line item. There is real institutional infrastructure being built around it. And then layer on top of that the Buy Canadian policy, the government's ambition to source 70% of new military equipment domestically, up from around 30% today. That is a structural shift in how defense dollars flow through the Canadian economy. So when you put those three things together, the spending commitment, the procurement reform, and the Buy Canadian mandate, you get a policy environment that really does look durable rather than cyclical. And that distinction matters a lot when you're thinking about how to position in this space over a multi-year horizon. Now, I want to be clear that we're not just taking the policy story at face value. The other thing that gave us real confidence is the structural demand resilience that sits underneath all of this. Fleet expansion and pilot retirements continue to drive ongoing training demand. Backlogs in business aviation remain healthy. Defense-oriented businesses are seeing contract pipelines that are, in some cases, multiples of their current backlog. These are dynamics that don't depend on a single procurement decision or a political cycle. They're durable in their own right, and the government policy backdrop is amplifying them, not creating them from scratch. That's an important distinction. When you have structural demand resilience in a highly supportive policy environment converging at the same time, that's when you tend to get the most interesting setups from an investment perspective. And I'll be very curious to see how it develops into the back half of the year.
Now, let's turn to Matt. Matt, can you fill us in on some of the larger picture, big themes that came out of the conference for the paper and forestry sector?
I'd start by saying that demand conditions across the space feel pretty tepid, and that I don't think we're in an environment where either management teams or investors are particularly optimistic around the near-term demand trajectory. We're struggling with affordability issues in housing and a cautious consumer more generally. But despite that, I think there are some interesting developments happening across the space and reasons for optimism. Saba made some comments about tariffs, and I'd highlight our lumber group in particular as seeing a big change on that front over the past year. Now, the US has assessed duties on Canadian lumber entering the market for a long time. They're really not a new phenomenon. But since Q3 of last year, those duty rates have been in unprecedentedly high levels, call it 35% or so for most producers, which is up more than 20 percentage points year over year. And then we had a new 10% Section 232 tariff that was added on top of that in October. So for Canadian companies who put softwood lumber into the US, and I would note that's about half of production that's being sold into the US by the Canadian industry, they've gone from paying about 14% and change to paying more than 45% as a combined duty and tariff rate, all in a soft demand environment. That's been really quite challenging to deal with. And again, demand is soft and prices just haven't responded. And what that's meant is that we've seen a continuation of a supply response by the industry, which, as one company at the event put so well, is reducing the level of equilibrium demand at which we'll see tight industry conditions. I think there's a sense that the US South could restore some amount of supply over the medium term, with industry utilization being a few points back of the historical average. But it's getting tougher to envision where the incremental supply comes from if we see a meaningful and sustained uptick in demand. In many cases, the mills that have been shut over the past few years are gone for good. European supply, which is equivalent to about 5% of US consumption, is also under pressure from a fiber perspective, and the higher ocean freight costs we're seeing can't be helpful for their economics. So as I look at lumber, I think we're seeing high duties and new tariffs start to write an interesting new chapter in what's been a multi-year downturn and industry rationalization cycle that has set us up for better conditions at lower levels of demand going forward. And that's part of our optimism in this space. And when I look elsewhere across other parts of the forest products ecosystem, there are echoes of these supply-focused themes. In containerboard, we're even a bit further along the supply side story in my view, in that the capacity rationalization last year in particular was really significant. Call it 8.5% of the North American industry taken down. Management commentary at the conference supported the idea that conditions are tight. Pricing has already moved $50 a ton higher this year, and producers are hiking prices at least $50 a ton, in some cases $70 a ton, for June. Again, the demand side is not helping. Box shipments last year were essentially the lowest we've seen in a decade. But the supply side has tightened so much that we're seeing prices head higher not just to offset cost pressures, and certainly there are some as we think about diesel and, to a lesser degree, chemicals, but we're also expecting price cost expansion as well. Conversely, we're probably not as far along that supply side story in softwood pulp, and pricing today is really tough for a lot of the cost curve. Part of the issue in pulp is that we've actually seen pretty significant capacity additions in lower cost hardwood pulp, including on an integrated basis in China. And that substitution across grades is challenging. Some capacity has come out, but not enough to balance the market. And I think we'll need to see both supply action and maybe a more stable demand backdrop to let a recovery play out.
And Walter, maybe shifting over to you to round off with some of your observations. What would you say were some of the bigger themes that straddle all industries within this relatively diverse space?
Yeah, there's two key themes that I think really crossed over on all of the presentations, and that was really around AI and capital allocation. Many companies noted that there was a growing role of AI driving operational efficiency, and this is especially so in the transportation sector. And that's based on the intricacies of product moves, having to deal with unexpected events, particularly around weather. As a result, while we don't see AI as being overly disruptive for the transportation sector, we do see it as a significantly enhancing one. Turning to capital allocation, that was an important thematic for companies across all the sectors as well. We heard each of the management teams offer disciplined plans around capital allocation, balancing organic growth with strategic M&A and shareholder returns. So at the end of the day, while much depends on resolution of external events, much of the industrial sector is finding ways around the big trade challenges, and the Canadian government's infrastructure drive is certainly boosting confidence. Saba, James, Matt, thanks for your inputs, and thank you all for joining the podcast here today. You've been listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on May 26th, 2026. Listen and subscribe to Strategic Alternatives on Apple Podcasts, Spotify, or wherever you listen to your podcasts. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.